Trump sees trade as a zero-sum game. A deficit means you lose, a surplus means you win. Is Canada headed for a prolonged trade war with the United States? How can Canada fight back? And what does this mean for your investments? Hi, I'm Ben Fawcett, Portfolio Manager at CG Wealth Management. And in this edition of Connecting the Dots, we'll break it down. Trump has gone ahead with 25% tariffs on all Canadian goods and 10% on Canadian energy. Trudeau announced 25% retaliatory tariffs, initially targeting $30 billion of US goods, with a further $125 billion in tariffs coming in less than 3 weeks. But what exactly is Trump trying to achieve with these tariffs? And what challenges does his administration face in escalating this trade war? Honestly, it's not clear. The administration hasn't given a definitive answer, though reports suggest they're considering several options. For starters, this isn't Trump's first trade war with Canada. For example, dairy and softwood lumber have been long-term points of contention between the two countries, with the US accusing Canada of unfair subsidies. Arctic security. As melting ice opens up new shipping routes, global players such as China and Russia are eyeing the region. Trump may want Canada to step up its defense and protect its northern sovereignty. And then there's the money factor. Trump's #1 priority is to lower taxes, but that puts a big hole in government revenues. Trump thinks that tariffs can help fill that gap. Tariffs act like a tax on all goods coming into the US that generates income for the US government, but that also comes at a cost. Even if Trump wants to push harder on tariffs, his hands aren't completely free. For starters, Canada is a critical trading partner for many US states, including Republican strongholds. If these states start feeling economic pain, such as job losses or higher prices, their representatives in Congress are going to have trouble supporting Trump's broader agenda, especially when they're up for re-election. And then there's Trump's campaign promise to lower costs for consumers. Tariffs do the opposite. Tariffs raise costs for consumers. Tariffs raise costs for businesses. And with promised tariffs on Mexico, Europe, China, and likely others, that problem only gets compounded. So while Trump may be using tariffs as a bargaining tool, he's also walking a very fine line, risking economic fallout, political backlash, and potentially damaging consumer sentiment. Let's connect the dots and see where this could all lead. Markets dislike uncertainty, but they do adapt. In the short term, some sectors and industries such as autos, manufacturing, and commodities could feel pressured. Other Canadian businesses that have significant US operations could actually benefit due to a depreciating dollar. Ultimately, however, given the deep economic ties between Canada and the US, a resolution remains the most likely outcome. And as the saying goes, a crisis is a terrible thing to waste. This could be the push that Canada needs to strengthen interprovincial trade, to diversify exports beyond the US, and to align taxes and regulatory policy so that investment and talent are retained within Canada. While short-term volatility is inevitable, a stronger, more competitive Canada could emerge, rewarding long-term investors. Countries naturally trade most with their closest neighbors. It's cheaper, it's easier, they're culturally aligned. While the current tensions create uncertainty, Canada and the US have too much at stake to not find common ground. And in the long run, Canada could come out even stronger if it seizes this moment to tackle long-standing economic challenges.